So today we are looking at this sprawling, just massive tech platform. It's got over 51 million active daily users.
Yeah, that's a huge user base.
Right. And it features this highly advanced artificial intelligence supply chain, a booming digital media network, and, predictive algorithms tracking millions of personal data points. Oh, and they also sell eggs.
They do indeed sell eggs.
Because today we are cracking open the Albertsons company's Q4 2025 and full-year earnings report. This was just released today, actually April 14, 2026.
Yeah, and along with that report, we got a pair of highly revealing press releases. One was regarding a new dividend hike, and the other, well, it was about a massive legal settlement.
Quite the combo.
Totally. And, if you think a grocery store earnings report is just a dry spreadsheet tallying up, like how many boxes of cereal went through the checkout line, you are missing the underlying reality.
Oh, absolutely.
This stack of financial documents is basically a real-time tracking device for the modern American economy. It sits right at this crazy intersection of technological automation, federal healthcare policy, and just the raw day-to-day macroeconomic reality of the consumer.
Okay, let's unpack this, because the mission today is to really decode how an 85-year-old supermarket empire, and we're talking about the whole umbrella here, right? Albertsons, Safeway, Vons, Jewel-Osco, all of them.
Dozens of brands, yeah.
Right, how this massive legacy company is quietly operating as a cutting-edge tech firm while simultaneously navigating some wild turbulence. Because the contrast buried in these pages is just incredible.
It really is. It's a story of absolute friction. You have billion-dollar algorithmic optimization happening on one end of the spectrum, right? And then on the other end, you have everyday shoppers carefully calculating their cart total just to afford basic staples.
Yeah.
The grocery store is literally where abstract global trends hit your wallet.
So true. Well, let's start right at the front of the store. Or I guess rather the digital front door. Because to understand Albertsons' financial health right now, you have to completely shift your perspective on what they actually do.
Right.
They are no longer just selling food to foot traffic. They are selling a highly personalized digital experience.
And the numbers from the fourth quarter, they show this transition in stark relief. Their digital sales surged by 16%.
Wow, 16%.
Yeah, and more importantly, their digital penetration surpassed 10% of total sales. For a legacy brick-and-mortar retailer, pushing past that double-digit digital threshold is a major validation of their strategy.
It's a huge milestone.
It is, and it goes far beyond just like grocery delivery. Their loyalty membership grew by 12%, bringing them to over 51.2 million active members.
That scale is just hard to wrap your head around. Over 51 million people are actively scanning an app or, typing in their phone number every single time they buy a gallon of milk.
Yep, every single time.
And they aren't just hoarding this data either. They are weaponizing it. In the earnings call, management laid out they called them their 4 big bets in artificial intelligence.
Yes, the 4 big bets.
Right. They are fundamentally restructuring their operations around AI, breaking it down into 4 distinct pillars. Let's walk through how these actually work, starting with the digital customer experience.
What's fascinating here is the psychological mechanism behind that first pillar. They're deploying these AI shopping assistants that dynamically alter your experience the second you open the app.
Oh, wow. Like customizing it in real time?
Exactly. The AI cross-references your purchase history with broader seasonal trends, local inventory, all of it. So say you usually buy taco shells on Tuesdays, but you forgot the salsa. The app's algorithm pushes a personalized promotion for salsa right to the top of your screen before you even search for it.
That is slightly terrifying, but brilliant.
Management noted this specific application is already successfully driving larger basket sizes. People are buying more because the AI is anticipating their blind spots.
So the second pillar is merchandising intelligence. And this isn't just like a manager walking down the aisle changing a price tag. It's an automated pricing and promotional strategy.
Totally automated, yeah.
The AI calculates local price elasticity, meaning it knows exactly how much they can raise the price of, say, a specific brand of orange juice in a specific zip code before sales drop off.
Right. Then you have the third pillar, which focuses entirely on the workforce labor optimization. They are using generative AI and machine learning to forecast store traffic.
Wait, to predict when people are going to shop?
Yes, and it analyzes everything. Historical shopping patterns, local weather forecasts, even community events. If the AI predicts a sudden rush on hot dog buns at 4 p.m. on a Friday because of a local high school football game,
Oh, that's crazy.
right, It dynamically adjusts employee schedules to ensure 3 cashiers are off their breaks and at the registers at 3:55 p.m. It is pinpoint labor allocation.
That is wild.
Yeah.
And finally, the fourth bet is the supply chain. They rolled out this proprietary AI tool called Gateway.
Ah, Gateway, yes.
Yeah, this system uses computer vision and predictive algorithms to manage center store inventory. So it isn't just looking at what's sold at the register. The system can practically see the depth of the shelves.
Like it has eyes on the peanut butter.
Exactly. It knows when the peanut butter is running low and automatically triggers a predictive order from the warehouse before an employee ever even walks down that aisle to check.
That's incredible efficiency.
Right, and when you look at these four big bets together, the best way to understand the modern Albertsons is to view it like a smartphone operating system.
Oh, I like that. With the physical store being the phone itself.
Exactly. Think about the physical glass screen and the metal casing of your phone. That is just the user interface. In a grocery store, the aisles, the shelves, the shopping carts, that is the physical UI.
You interact with it, but the software is running the show.
Right. The real magic is that invisible software layer operating in the background. It tracks those 51 million users to optimize everything. I mean, from the targeted ads on your screen, to the supply chain trucks on the highway, to the lunch breaks of the cashiers. The physical store is just the hardware.
And, the executives on the earnings call, they were incredibly transparent about the financial imperative driving this software layer. This is the engine of a massive $2 billion 3-year productivity program.
See, that's what gets me. Finding $2 billion in savings inside a business that famously operates on, like, razor-thin margins, that seems nearly impossible. Where is that cash actually coming from?
Well, it comes from systematically eliminating friction and waste. A huge target of this AI is reducing what the retail industry calls shrink.
Okay, shrink, just inventory loss, right?
Exactly. And that covers everything from organized retail theft to, a pallet of strawberries spoiling in the back room because they were misrouted. By using that gateway system to optimize the supply chain, trucks aren't driving half empty, and highly perishable food isn't just sitting on loading docks.
So they're just squeezing out all those operational inefficiencies.
Precisely. They're generating financial fuel. They take those billions in operational savings and redirect them into the aisles to keep their retail prices competitive. It basically allows them to fight macroeconomic inflation on behalf of the consumer without destroying their own corporate profit margins.
Okay, so AI is hyper-optimizing the digital app, the employee schedules, and, the dry goods in the center of the store. But if we walk from the produce section all the way to the back of the building, to the pharmacy counter, a completely different, highly volatile force takes over.
Oh, definitely.
We step out of the realm of predictive tech and straight into the crosshairs of federal policy and pharmaceutical trends.
Yeah, the pharmacy was arguably the biggest point of friction in this entire Q4 report. Management disclosed that pharmacy headwinds created a massive 145 basis point drag on their identical store sales.
Okay, let's translate that for a second. Because identical store sales, or comparable sales, that's a metric used to measure revenue growth only at stores that have been open for at least a year, right?
Right, it strips out the bump they get from just opening new locations.
Exactly. And a 145 basis point drag means the pharmacy issues essentially pulled their comparable sales growth down by nearly 1.5%. In the grocery business, where margins are fractions of a penny, a 1.5% drag is a massive, heavy anchor.
It is a profound headwind, and it was primarily driven by two external macroeconomic factors that are honestly entirely divorced from how well Albertsons actually runs its stores.
Right, external forces.
Yeah. The first factor they highlighted involves federal legislation, specifically the Inflation Reduction Act, or the IRA.
And just to be clear for everyone listening, we are looking at this strictly through the lens of a corporate financial disclosure. We aren't weighing in on the politics of healthcare policy. We are just reporting on the business mechanics here. So how exactly did the IRA drain revenue from the Albertsons pharmacy?
So the IRA implemented a Medicare drug price negotiation program, right alongside changes to out-of-pocket spending caps for seniors. According to the Albertsons CFO, the pricing and mix pressure from these IRA changes hit the market much faster and much harder than the industry modeled.
Oh, wow. So they were caught somewhat off guard by the speed of it.
Yeah. The legislation fundamentally altered the reimbursement landscape from pharmacy benefit managers. Albertsons is essentially getting squeezed on the top-line revenue they can collect for dispensing these regulated medications.
Okay, that makes sense. Now, the second major headwind they cited is something dominating the news cycle right now, GLP-1 weight loss medications.
Yes. They experienced a sudden moderation in the growth of GLP-1 sales. And, I mean, it is not a demand issue. Consumer demand for these drugs remains sky high.
Obviously.
Right. The issue is that insurance payers are aggressively tightening their criteria. Health plans are increasingly refusing coverage for these highly expensive drugs if they're prescribed strictly for weight loss rather than, say, diabetes management.
So fewer people can actually afford to fill them.
Consequently, yeah, fewer expensive prescriptions are being filled at the counter, which, again, drags down total pharmacy revenue.
But looking at the financial data, there's a really counterintuitive twist here. Even though the top-line revenue dropped because of the IRA pressure and the GLP-1 slowdown, the pharmacy's actual profitability, their margin improved. How do you make more money while ringing up fewer sales?
You do it by changing the product mix. Because of these insurance pressures, the pharmacy dispensed a higher ratio of generic drugs compared to expensive brand name drugs. And structurally, generic drugs are much more accretive to a pharmacy's bottom line.
Accretive meaning they add more direct value to the profit margin.
Exactly. Let's say a brand name drug costs $1,000, but the pharmacy only makes $10 in profit for dispensing it. It inflates revenue, but the margin is tiny.
Right.
A generic alternative, on the other hand, might only ring up as $50 at the register, significantly lowering total revenue, but the pharmacy might make $15 in pure profit on that script. So selling fewer brand-name GLP-1s and more generics lowered their gross revenue, but it actually increased their underlying profitability.
Okay, but hold on. If insurance companies are blocking access to appetite-suppressing GLP-1 drugs, wouldn't those customers naturally revert to their old dietary habits? Like, if they're off the weight loss drug, wouldn't they start buying more food? Doesn't the grocery side of Albertsons actually win in this scenario?
You know, it is a brilliant hypothesis, and it's actually something Wall Street analysts pressed management on during the earnings call. But if we stick strictly to the data management provided, the answer is no. There is no hidden windfall for the grocery aisles.
Really? Why wouldn't food sales spike if appetite suppressants are slowing down?
So the CFO clarified the underlying behavioral data. Shoppers who are filling GLP-1 prescriptions are generally already highly loyal, sticky customers of the broader store. Whether they are on or off the medication, their core shopping habits remain anchored to Albertsons.
Oh, I see.
Yeah, the drop in GLP-1 sales is a proven headwind for the pharmacy's revenue, but management explicitly stated there is no immediate measurable correlation to an increase in center store food traffic.
So it's not a zero-sum game where pharmacy losses equal grocery gains.
No, not at all. But management was quick to point out a crucial silver lining. Despite the GLP-1 issue, overall prescription script counts, like the raw volume of prescriptions being filled, are still growing.
And that's vital for them.
Huge. If a customer comes in to pick up a high-margin generic blood pressure medication, they're highly likely to grab a carton of milk and a loaf of bread on their way out. The pharmacy acts as this powerful magnet for foot traffic, driving the lifetime value of that shopper across the entire physical footprint of the store.
Okay, so the reality of those pharmacy sales specifically, patients losing insurance coverage for weight loss drugs, points to a much broader theme. Consumers are financially squeezed. Which brings us out of the pharmacy and right into the center store grocery aisles. Because this is where the macroeconomic reality of the American middle class is playing out in real time.
And the data paints a picture of a highly stressed consumer base. Overall, identical store sales only rose a meager 0.7% in the fourth quarter.
That's practically flat.
Yeah. I mean, if you exclude the massive pharmacy drag, the number looks slightly better. But the underlying truth remains industry-wide. Actual unit volume is under immense pressure. People might be paying slightly more due to inflation, but they are physically putting fewer items into their shopping carts.
Right, and the CEO highlighted that this pressure is not evenly distributed. Higher and middle income shoppers are holding relatively steady, but the lower income cohorts are highly sensitive right now.
Very sensitive.
Management specifically called out pressure stemming from recent changes in SNAP regulations, the Supplemental Nutrition Assistance Program, combined with just general compound inflation fatiguing the lower-income shopper. But amidst all of this heavy macroeconomic analysis, the earnings report detailed one of the weirdest financial headwinds you will ever see in a corporate document.
Oh, yes. Egg deflation.
Egg
Oh,
deflation. It sounds trivial, but the mathematical impact on their balance sheet is massive. We have to look back to 2024 when severe avian flu outbreaks caused unprecedented egg shortages across the country.
right. The prices were insane.
The price of a carton of eggs skyrocketed. So a year ago, Albertsons' top-line revenue figures were artificially inflated by those astronomically high egg prices. Fast forward to today, the supply chain has largely normalized, and the cost of eggs has plummeted back to historical averages.
So when analysts compare Q4 of 2025 to Q4 of 2024, it mathematically looks like Albertsons is suddenly losing massive amounts of money in the dairy aisle.
Exactly. If a carton went from $10 down to $3, their revenue drops by $7 a unit, even if they are selling the exact same physical number of eggs.
They're simply cycling past a historical anomaly.
Yeah.
But it creates this bizarre statistical drag on their current growth rate, a headwind they expect will persist deep into the first quarter of 2026.
It perfectly illustrates the inherent volatility of the grocery sector. Your financial optics are at the mercy of complex global supply chains, federal healthcare policies, and literally the health of a flock of chickens in the Midwest.
It's wild. And because of all this compounding pressure, consumer psychology is shifting dramatically. Shoppers are leaning heavier than ever into those loyalty programs we discussed earlier. But the behavior inside the app has completely changed.
Yeah, and here's where it gets really interesting. The CEO explicitly noted that customers are abandoning long-term points hoarding in favor of immediate cash-off rewards at the checkout terminal.
It is a shift from aspiration to survival.
It really is. I mean, in the past, loyalty programs were gamified. You'd happily rack up digital points for 6 months to earn a free premium turkey for Thanksgiving, or you'd stockpile rewards for a big discount on summer road trip
All right,
gas.
it was fun.
Yeah. But today, the modern loyalty app functions more like the extreme coupon clipping of the 1990s, but driven by necessity rather than sport. For a lower-income shopper fighting compound inflation, scanning that app and selecting "Take $3 off my bill today" is a vital weekly financial tool. They can't afford to wait for a turkey in November. They need the dollar off their total right now just to make their grocery budget work.
If we connect this consumer desperation to the bigger strategic picture, it explains exactly how Albertsons is playing defense. They know their core shopper is hurting, but they still have a massive corporate structure to fund.
They can't just slash prices everywhere.
No, they cannot afford to implement broad, sweeping price cuts across the entire store. That would obliterate their profit margins. Instead, they are deploying what they call surgical investments in price.
It's like triage in a hospital emergency room. They aren't treating every minor scratch. They are identifying the specific items causing the consumer the most immediate financial pain and addressing those first.
That is a perfect analogy.
Yeah.
Because of the granular data flowing from those 51 million loyalty members, the AI algorithms know exactly which items dictate a shopper's perception of value. They refer to these as key value items.
Like bread and milk.
Think of staples like a specific size of milk, bananas, or a popular brand of bread. Albertsons will intentionally slash prices on these specific, highly visible items to offer the consumer immense, immediate relief where they notice it the most.
And to subsidize those price cuts, they are simultaneously leaning incredibly hard into their private label products, what they call their own brands, like O Organics or Signature Select.
Right.
By heavily promoting these private labels, which carry a much higher profit margin than national brands, they protect their overall corporate profitability while still projecting a lifeline of value to the squeezed consumer.
So we have seen how they operate as an AI platform, how they manage pharmaceutical volatility, and how they perform price triage for a stressed consumer base. The natural question is, how does all of this actually roll up into the company's bank account?
Yeah, let's talk about the money, because the Q4 financials present a staggering paradox. It is a paradox of heavy legal penalties sitting directly alongside extreme shareholder confidence. Let's look at the actual ledger. On the positive side of the sheet, the company reported better than expected adjusted EBITDA of $903 million.
And we should probably clarify EBITDA, that stands for earnings before interest, taxes, depreciation, amortization.
A bit of a mouthful.
Yeah, but it's essentially the raw operating cash the core business generates from selling groceries before the accountants start applying complex tax and depreciation formulas. Generating $903 million here means the fundamental grocery engine is highly profitable. They even beat Wall Street's expectations with an adjusted earnings per share of 48 cents.
But on the exact same financial document, they reported a GAAP net loss of $481 million for the quarter.
A nearly $500 million net loss under generally accepted accounting principles.
Right. And that massive loss was almost entirely driven by a major legal development. Albertsons announced a $774 million proposed nationwide opioid settlement framework.
That's a huge figure.
Yeah, this agreement is designed to resolve widespread claims brought by state, local, and tribal governments regarding the dispensing of prescription opioids. Now, the company explicitly admitted no wrongdoing and no liability. However, to resolve the claims and move forward, they took a $600 million net of tax charge in the fourth quarter.
And this is where the accounting rules create a really distorted picture. The actual cash payouts for this $774 million settlement will be staggered. They're going to be spread out over 9 years. But under GAAP rules, they must recognize the vast majority of that financial hit on the books today.
And yet, despite officially taking a $600 million accounting charge and reporting a $500 million net loss for the quarter, something incredible happened. On the exact same morning, in the exact same batch of press releases, the Albertsons Board of Directors authorized a 13% increase in their quarterly cash dividend.
Yeah, a 13% bump.
And on top of that, they announced a brand new $2 billion share repurchase authorization.
A massive commitment to buy back their own stock from the public market.
I read that and immediately hit a wall of confusion. How can a company report a $500 million net loss, agree to a $774 million legal settlement, and in the very same breath raise their dividend by 13% and commit $2 billion to buy back stock? To anyone looking at a basic checking account, that sounds mathematically impossible.
Well, it sounds completely contradictory until you separate the concept of a paper accounting loss from the reality of underlying cash flow. The opioid settlement is a massive one-time accounting charge that craters the official quarterly net income. But, as we noted, the actual cash leaving the corporate bank account is manageable because it's spread across nearly a decade.
Oh, I see.
It's akin to taking out a large mortgage. Your total debt on paper is huge, but your actual monthly cash payment is sustainable.
The accounting loss doesn't drain the vault today.
Precisely. Meanwhile, the underlying cash generation of the actual grocery business, represented by that $903 million in adjusted EBITDA, is incredibly robust. Think back to the first section. That $2 billion AI productivity engine is actively reducing inventory shrink.
Right.
The pharmacy is capturing higher margins by shifting to generic drugs. The private label strategy is insulating their grocery profits. That core retail engine is just humming. By raising the dividend and authorizing billions in stock buybacks, the executive team is sending a very loud, highly intentional signal to Wall Street investors.
They are essentially telling the market, do not panic about the headline loss.
They are saying the legal baggage of the past is finally ring-fenced and being dealt with. The one-time hit is behind us. Look at our free cash flow. The core grocery operations are throwing off so much excess cash that we can easily afford to handle this 9-year settlement, continually reinvest in our stores and AI tech, and still generously reward our shareholders with higher dividends. It is a massive flex of corporate confidence in their underlying business model.
It completely reframes how you look at a simple trip to the supermarket. We've spent the last chunk of time unpacking what is essentially a living microcosm of the modern American economy. And I want to bring this all back directly to you listening to this deep dive right now.
Yeah, absolutely.
The next time you walk through the sliding doors of a grocery store, or the next time you open a store's app and tap a button for a digital cash-off reward, realize that you aren't just buying a carton of milk and a dozen eggs. You are actively interacting with a sprawling, AI-driven retail media network. You are participating in an ecosystem that is simultaneously balancing billion-dollar tech investments, federal healthcare drug pricing, and the intense macroeconomic realities of inflation, all based on the data generated by what you choose to put in your cart.
And that reality leaves us with one final vital question to consider. Something that has been lingering just beneath the surface of all these complex financial metrics. We've detailed their 4 big bets in artificial intelligence. We've talked about the behavioral data of 51 million active loyalty members and the sophisticated digital network tracking every single transaction.
Right.
As these retail giants leverage advanced AI to understand our personal health profiles through the pharmacy counter and comprehensively map our dietary and financial habits through our grocery lists. I mean, at what point does the personal data they collect about us become fundamentally more valuable than the actual food they sell to us?